A record $7.6 trillion in cash is currently parked on the sidelines of the financial system. That's more than ever before, and the last three big cash piles coincided with the 2020 pandemic, the 2008 financial crisis, and the 2000 dot-com bubble. These were times when fear drove investors away from risky assets like stocks and towards cash, making this look like a bearish signal, at least at first glance. This cash is in money market funds. That's mostly short-term government bonds like treasuries, and it's not really doing anything besides soaking up high interest rates without much risk. Money market funds offer an annualized return of around 4.25%. That's for risk-free short-term bonds. Compare that to the measly 0.6% you'll get from a standard bank savings account, and it starts to make sense why so many investors have flocked to them. These funds are also highly liquid, so money can be withdrawn and quickly reinvested in other assets where investors perceive better returns. But it's a wonder why that hasn't happened already, because it sure looks like the stock market could bring better returns. But the stock market comes with risk and uncertainty. This big dip back in April 2025 is a case in point. Trump's tariffs threw everyone for a loop. Unsure what was going to happen next, the markets tanked, and economic policy uncertainty reached an all-time high. It's come back down, but it remains elevated. When this measure is high, it signifies a general uncertainty about what's going to happen next. And when it comes to investing in riskier assets like stocks, investors want as much certainty as they can get. So this elevated uncertainty is incentivizing cash on the sidelines. But the rush into money market funds goes back a few years. It really kicked off in 2018 as the Federal Reserve began hiking rates after years of hovering near zero. It stalled during the pandemic recession, then bolted back up again in 2022 when the Fed launched its most aggressive rate hiking cycle in decades to combat post-pandemic inflation. As a result, the yield on short-term government debt, the primary ingredient of these funds, soared. This trend picked up pace even more in 2023. A localized banking crisis collapsed confidence in traditional lenders, pushing investors to seek the perceived safety of liquid assets like treasuries. But the Fed has begun slowly cutting rates again. If that continues, and as the risk-free return on cash drops, investors are expected to pull their money from safe assets and hunt for returns in riskier assets. They haven't started doing that yet, though. And despite the huge number of $7.6 trillion, there are a few reasons to believe this cash allocation isn't as big as it seems. First, analysts at JP Morgan think that just about $800 billion of this pile, mostly retail cash from individual investors, is actually considered a flight risk. The cash allocation of retail investors is currently between 15 to 20%, which is actually below historical averages, and nowhere near the humongous cash piles we saw during the financial crisis in 2008, when fear reigned and people were fleeing risky assets in droves. The most recent peak above the historical average came during the 2022 bear market, but quickly went back down again. And here's another way of looking at the rise in money market funds as a percentage of the S&P 500. This shows us cash allocation relative to stock investment, and historically it's not actually very high. It was much higher during these peaks after the dot-com bubble burst in the early 2000s and during the great financial crisis. So despite reaching record amounts, it's nowhere near previous peaks when compared to investment in the stock market. The yield on cash, like 3-month treasuries, has only just fallen below the yield on 10-year bonds, so that could initiate a shift away from holding cash if the trend continues. Analysts at JP Morgan suggest that unless the Fed funds rate falls below 3%, cash balances are unlikely to shift significantly. Current forecasts for this cycle fall anywhere between 2.85% and 4.19%. If rates stay toward the higher end of that range, the incentive to move remains low. There's also the valuation problem. By many measures, US stocks are more expensive than ever, especially amidst fears of an AI bubble ready to pop. As long as valuations remain this high, the stock market doesn't appeal to investors as a good investment. And then there is the demographic shift. The US population is skewing older and older. This line shows the age distribution for the US population in 2000. The left is younger and the right is older. Here is the age distribution today. There are many more older people, and an aging population naturally favors the liquidity and safety of cash over the volatility of riskier assets. If a reallocation does happen, it likely won't hit the stock market first. Cash tends to flow into the bond market before equities, moving from least to most risky. If investors shift from short-term cash to longer-term bonds, it would drive up bond demand and reduce yields. And that shift into long-term bonds could actually be more bullish for the economy than a direct move into stocks. Lower long-term yields mean cheaper mortgages and cheaper corporate bonds and financing, improving balance sheets without requiring new growth. That's bullish for the economy. if it plays out that way. Despite the tall mountain of cash, it perhaps isn't the coiled spring for the stock market that many bulls hope for. Most of this money is there for liquidity and safety, and investors seem perfectly willing to wait for a genuine discount before jumping back into the fray. At Capital.com, we'll keep you updated on global liquidity trends and the shifting relationship between cash and the stock market. Hit like and subscribe to stay tuned. Thanks for watching.